Welcome to ABC Campus. Today we have a query in which a student has asked that the business entity concept means owners are separate from business. And yes, they are separate. In accounting, they are considered separate from business, whether it's a sole trader business, partnership business, or even a company which is registered under the relevant law. Then why claim of honors is equity and not liability? So the question is that if honors are separate from business, they are not considered a part of the business, then why their claim on the business is not considered a liability? Rather, we classify it as equity and treat it and present it separately from liabilities. So for this query to respond for by us, let's first discuss what is separate business entity concept. So separate business entity concept is that owner and the business are separate entities. And when we record transaction between business and owner, those transactions are recorded from the perspective of the business and not from the perspective of the owner. And now it is very important that we look at the definitions of liability and equity. So the definitions of liability and equity are given in conceptual framework 4.2 paragraph, and it says that liability and equity both are claims. Liabilities are those claims of persons other than owners. And the definition of liability is that it is a present obligation of the entity to transfer an economic resource as a result of past event. And equity is residual interest in the assets of an entity after deducting all its liabilities. So equity is precisely what reflects the accounting equation. So it is assets minus liabilities. So equity is equal to asset minus liabilities. Now, in the light of these two things, that the separate business entity concept and the definition of liability and equity, now we can compile our response. So our response is that business entity is considered separate from its creditors or lenders, for which we record liabilities, and owners or shareholders or members of a company, for which we record equity. So both liability holder and both equity holder as well, they are separate entities from the business entity. So what is the difference between liability and equity? If we look at the definition, it says that liability is a present obligation. Let's focus on the word obligation. Obligation for what? Obligation to transfer an economic resource. And why they have this obligation? Because as a result of past event, they did something in the past. They bought goods on credit or they took a loan from the bank that created that obligation. So in liability, an obligation exists. In equity, there is no obligation. Now, it means clearly from the definition that equity is claim on assets, liability is also claim on asset, but equity is claim on asset that are not liabilities, because it says after deducting all its liabilities. So by definition, equity are claims against the entity that do not meet the definition of a liability. So clearly with the definition, the claims are different. Claim of owners are different and claim of creditors and lenders are different. So why these claims have been separated? Why framework defines liability in a different way and equity in a different way? Both are claims on the assets of an entity. This is because it is useful to separately present liability claims and equity claims, as both type have different profiles in terms of involvement with the management of entity, its operations, and the business risks that are faced by an entity. Now let's elaborate on this point. For example, liability holder, for example, a lender, a bank who has provided the loan to the business entity, they are interested in the profitability of the business only to some extent. They are only interested in taking the repayment of their loan and to get the interest. And their risk is comparatively lower than owners. For example, why? Because even if the entity incurs losses, they will get their interest. But the risk of owners is unlimited, and it is much more than liability holders. So if there is a loss in business, they cannot get any distribution of profit, because there are no profits to be distributed at all. So owners generally have higher risk. So both claim holders have different profile in terms of risk they undertake. In a business entity, the operational impact of operational risk is different, and their involvement with the management is different. Creditors have no say in appointing the board of directors or management of an entity, while in the same company, the shareholders who are owners, they vote and elect board of directors, which actually and effectively ultimately run a company. So we can conclude on the basis of this discussion that separate business entity concept is not in conflict with the definition of equity. Separate business entity concept applies on owner, and it also applies on creditors as well. They are also separate entity. The reason we differentiate and distinguish liability and equity is because although both are claims on the assets of an entity, these claims are not similar in terms of their risk profile and their involvement with the business entity. So that's all for today. Have a good day.